Hey everyone, welcome back to Corporate Decoder. Today AWP just filed a 6-month report and I'm seeing some interesting shifts in their financial health. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company did a 1-for-3 stock split earlier this year, and we are going to look at how that is playing out in their latest numbers. So this filing is from abrdn Global Premier Properties Fund, ticker AWP. It covers their performance up to the 30th of April 2026. A big event happened in February 2026. They did a 1-for-3 reverse stock split. What this basically means is that for every 3 shares you owned, you now only have 1 share. The idea behind this is usually to make the stock price look a bit higher and more attractive, sometimes to avoid being delisted from an exchange. They also mention that the net asset value, or NAV, has been updated to reflect this. This is standard practice after a split. Let's dive into the numbers, starting with their net asset value per S-share. At the beginning of this 6-month period, October 2025, the NAV was $11.37. Now, at the end of April 2026, after the reverse split, the NAV is $11.97. That is an increase, which is generally a good sign. What about the market price? At the end of April 2026, the shares were trading at $11.96. So the market price is very close to the NAV, which is also a good thing, meaning the stock isn't trading at a huge premium or discount. For the 6 months ending the 30th of April 2026, the total return based on market price was 9.23%. This is lower than the return based on net asset value, which was 11.92%. This difference is important. It means that while the underlying value of the assets in the fund grew a bit more, shareholders who sold their shares during this period likely got a bit less. Their benchmark index, the FTSE EPRA Nareit Global Index, returned 10.01% over the same period. So, the fund's NAV growth slightly beat the benchmark, but the market price return lagged a bit behind. If we look at the last full year, ending in October 2025, the NAV return was actually quite low, only 2.10%, and the market price return was also low at 2.10%. This indicates a period of slower growth before this 6-month reporting period. Looking at the Statement of Operations for the 6 months ending the 30th of April 2026, their net realized gain from investments was over $4.2 million. That is a solid positive number. And even better, the change in unrealized appreciation on investments was over $32.5 million. This means the value of their existing holdings went up significantly. Their net investment income for the period was just under $3.1 million. This comes from dividends they received after foreign taxes, which were about $6.2 million. Now, expenses are always a big part of these reports. Their total operating expenses, not counting interest on loans, were about $2.4 million, but they also had interest expenses of over $712,000, largely due to their line of credit. Speaking of debt, their outstanding balance on the line of credit was nearly $43 million as of the 30th of April 2026. This is a significant amount of leverage. The asset coverage per $1,000 on this line of credit is over $9,500 as of the 30th of April 2026. This number means that for every $1,000 of debt, they have $9,500 in assets to cover it. This ratio shows they have more than enough assets to back their debt, which is a good sign of financial stability. Let's look at where their money is actually invested. As of the 30th of April 2026, a huge chunk, 78.5%, is in the United States. The next biggest chunk, 8%, is in Japan. Within the United States, a very large portion of their investments, 26.7%, are in retail REITs, real estate investment trusts. Healthcare REITs are also a big part at 24.8%. This makes sense given the fund's name. Their top holding as of the 30th of April 2026 was Welltower Incorporated, a REIT. It made up 12.6% of their portfolio. Looking internationally, in Australia, they have 1.6% in diversified REITs. And in France, they have 2.9% in retail REITs. In the US, data center REITs make up 12.1% of their portfolio. Overall, their total common stock investments are valued at over $411 million. Interestingly, they show liabilities in excess of other assets at negative 11.3%. This is a bit of a red flag as it suggests their liabilities could be a significant factor in their net asset value. Their total net assets are just under $369.3 million. The total assets of the fund are over $415 million. But remember, over $42 million of that is that line of credit payable. When we look at the composition of net assets, they have over $377 million in paid, in capital in excess of par, but an accumulated loss of over $8 million. This shows a history of operations that have, on paper, resulted in a loss. despite the recent strong gains. Looking at the statements of changes in net assets, there was a net increase in assets from operations of almost $40 million during this 6-month period. This is driven by those unrealized gains we saw earlier. However, they paid out over $21 million in distributions from distributable earnings, and their capital transactions also saw a net increase of over $10 million. Their net assets at the beginning of the period were about $340 million, ending up at $369.3 million shows growth, mainly fueled by the investment performance rather than large capital injections. For cash flow from operations, they purchased investments worth over $104 million and sold over $100 million. On the financing side, they increased their line of credit payable by over $12 million. They paid out nearly $20 million in distributions to shareholders. This is a pretty significant cash outflow. Overall, their cash balance saw a net increase of about $2.4 million. Going back to the financials highlights, the NAV per S-share at the beginning of this period was $11.37. Net investment income per share was about $0.1 for the 6 months. And the big story, the net realized and unrealized gains per share were almost $1. This is a strong performance for the period. So the total gain from operations per S-share was $1.08 combined. They distributed $0.48 per S-share in distributions, which brings us back to that end of period NAV of $11.97 and the market price of $11.96. The total investment return based on NAV for this 6-month period was a healthy 11.92%. Their gross operating expenses were 1.80% annualized, and importantly, net operating expenses after fee waivers and excluding interest were 1.39%. This shows that while the headline expense ratio might seem high, the actual costs borne by shareholders are managed. The portfolio turnover rate was 26% for this period. This is a moderate turnover, suggesting they are not actively trading in and out of positions excessively. The line of credit payable outstanding at the end of the period was about $42.9 million. And that asset coverage ratio we saw earlier, $9,599 per $1,000 of debt, is a key indicator of how well they can service that debt. It is quite strong. Now let's briefly touch on some of the accounting practices. They value their securities at fair value, meaning they use market prices when available, or estimates if not. They use a 3-level hierarchy for fair value, with level 1 being the most reliable based on unadjusted quoted prices in active markets. Currently, over $312 million of their investments are classified as level 1, meaning they are valued based on readily available quoted prices. Around $98 million are classified as level 2, which means they use other observable inputs like prices for similar securities. They have no level 3 investments which are valued using unobservable inputs. This is good, as level 1 and 2 valuations are generally more reliable. The company has a significant line of credit with BNP Paribas, up to $175 million. As of the 30th of April 2026, they had borrowed almost $43 million. The interest rate is variable, tied to SOFR plus a spread. They've pledged selected assets as collateral, meaning if they can't pay, BNP Paribas can claim those assets. The average borrowing for this period was around $29.7 million at an average interest rate of 4.78%. This section really details the risks of investing in this fund. They are heavily invested in real estate, which means they are sensitive to the real estate market. They also mention emerging markets risk, equity securities risk, and foreign currency exposure risk. There is also issuer risk, where the value of a security can drop because of problems with the company itself. The fund uses leverage, which amplifies both gains and losses. Management risk is also noted, meaning the fund's performance depends heavily on the skills of their investment advisors. Market events risk is a big one, unpredictable fluctuations due to economic trends, government actions, or global events. Things like pandemics can significantly impact the economy and thus their investments. And of course, REIT and real estate risk is front and center, covering everything from property values and tenant defaults to interest rate changes. Interestingly, there have been no changes to their portfolio managers, which suggests stability at the management level. Looking at share repurchases, they did not repurchase any shares through their open market repurchase program during this 6-month period. This means they are not actively trying to reduce the number of outstanding shares, which would typically boost per share metrics. The maximum number of shares they are allowed to repurchase under this plan is still over 6.3 million. So to wrap it up, abrdn Global Premier Properties Fund had a solid 6 months in terms of investment performance, with significant unrealized gains driving up their net asset value. The reverse stock split seems to have been a cosmetic change that hasn't immediately altered their market price significantly relative to NAV. They are carrying a substantial line of credit, but their asset coverage is strong. The biggest risks remain tied to the real estate market and broader economic uncertainties. The lack of share repurchases means growth in per-share metrics will rely almost entirely on investment performance. That is my take. Stay decoded. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. Like this video and subscribe for more insights. Check out the Discord link in the description too.